earnings one for this example on the 29th of June. It was trading at 113. So right here, you can see where it was, goes down. And then here was just another one on the 28th of September, trading here. It had a spike up. Okay, so here's the pairs right here. Now this one is actually adjusted for dollar equivalent. So they're kind of a dollar adjustment to make each one kind of dollar equivalent to each. And I'll show you then how to set that up next weekend in the course as well. And that's typically how we'll do it. We'll make these dollar equivalent, okay? So here was where Nike was trading here on the 26th. You can see the spread right here. It was trading at 72 over, right here. Where was, let me see, right here. See the red right there? Barely see it. So at that point, Nike, hold on one second here. Right here, right there. At that point on this was when the earnings were released, the day after on the 29th, before the day before it was released, Nike was $72 above SPY on an adjusted basis, okay? One-to-one kind of adjusted, okay? So it was $72 above SPY. Now, then you can see what happened. Nike had bad earnings. What happened? Nike started going down, but SPY was going down less or going up. So it didn't matter. It was just playing the spread between Nike and SPY. So the spread was, it was getting crushed versus SPY. So this would, you'd be short Nike, long SPY, and this was spread, is what you would get. So then that spread went down from 72 over. It went to right here 14 under, so it had just got annihilated. So that was a move of 72, and then you had the 14 where it was down here. This was a movement of $86 per share. If you did this with the one option contract, one short Nike, long SPY, that would have been up $86 per share or per 100. One option contract equivalent to 100 shares, you'd be up $8,600. All right, so that's what you're going to learn how to do in these kind of post-earnings trades. So if you've done this spread where you were short Nike, or you could look at the other way around, you're long SPY, short Nike, that spread went from 72 over, 14 under. It was up $86, $8,600 a share per 100. So one contract, right? And then here's the other one right here. This is where it went the other way around. So this is where Nike had good earnings, and it gave the catalyst for Nike to start really expanding, moving out faster than SPY. So at this point, Nike was trading at $2.50 under right here, that blue line. And then it started widening on the spread. So it started performing better than SPY. So this was, long Nike, short SPY, went from 2.5 under, Nike under SPY, to 81.5 over SPY, right up here. So that was an increase of 2.5 under plus the 81.5 over, $84 per share, which would be $8,400 if you did this with the options, okay? So that's going to be part of the course, what we're going to go through as well next week. And so there's a lot of great stuff that you're going to learn here